All right, let's dive into one of the most important investing books ever written, The Intelligent Investor by Benjamin Graham. This book was first published way back in 1949, but its wisdom is, believe it or not, more relevant today than ever. So let's get right into what makes this book such a timeless guide to building real, lasting wealth. Okay, let's just start here with this quote. This perfectly captures the absolute frenzy of the dot-com bubble. It was a time when all the old rules were declared dead, and this new era of easy money was supposed to be upon us. This was the voice of pure speculation, basically promising a sports car for anyone who is willing to ditch the old-fashioned, sound principles of investing. And that quote, well, it leads us directly into Wall Street's big, dangerous bet, speculation. It's this whole mindset that treats the stock market not as a place to own pieces of real businesses, but as a giant casino, where you're just hoping your number comes up next. And what's so striking is just how familiar all of this feels, right? Back in the late 90s, you had day traders who just scoffed at the idea of long-term investing. You had ads showing people making thousands of dollars with just a few clicks. The media was crowning these handful of tech stocks as the only ones worth owning. Look, this wasn't investing. It was a high-stakes game of chicken, completely fueled by this wild belief that prices would just go up forever. It's the big question, isn't it? Because every single one of these speculative manias, whether it's the dot-com bubble or something else, it always ends. And when that music stops, it's the speculators who are left holding the bag, every single time. And this is exactly where Benjamin Graham steps in. He just cuts through all that noise, all that chaos, with a simple, powerful distinction that honestly changes the entire game. Let's really look at how he defines what we're actually supposed to be doing here. Graham's definition, it's so simple, but so powerful. For him, a real investment has to meet 3 criteria. First, you got to do your homework. That's the thorough analysis part. Second, you have to protect yourself from a major loss. That's safety of principle. And third, you aim for a satisfactory, an adequate return, not a mind-blowing one. Anything else, by his definition, that's just speculation. End of story. And this just lays out the 2 paths perfectly. The investor, they make money for themselves in the long run by focusing on the actual business underneath the stock. They're always asking, how much can I lose here? How can I protect my downside? But the speculator, well, they're making money for their brokers with all that frantic trading, focusing only on that little flickering stock price and asking, how much money can I make today? It's really a choice between building actual wealth and just gambling. Okay, so if we're supposed to ignore the market's crazy price swings, how do we actually do that without going crazy ourselves? Well, Graham gives us one of the greatest metaphors in the history of finance to help us manage our own behavior. It's time to meet Mr. Market. So here's the deal. Imagine you're in business with this partner named Mr. Market. And every single day he shows up at your office and he offers to do one of 2 things, either buy your shares from you or sell you his shares. The only catch is, the price he quotes is totally dependent on his mood that day. Some days, he's just completely euphoric. He sees nothing but sunshine and rainbows ahead. On those days, he'll offer to buy your shares for ridiculously high prices, way more than they're actually worth. But then, on other days, he is just terrified. He's completely inconsolable, convinced the world is about to end. And on those days, he will desperately offer to sell you his own shares for pennies on the dollar, just so he can get out. And right here, this is the genius of Graham's idea. You are totally free to ignore Mr. Market. His mood swings are his problem, not yours. His silly high prices are an opportunity for you to sell. His absurdly low prices are an opportunity for you to buy. You are in control, not him. So, how do we know when Mr. Market's prices are actually silly? Well, that brings us to Graham's single most important concept, the absolute bedrock of his entire philosophy. The margin of safety. I love this analogy, it's fantastic. Think about it. When you buy groceries, you look for value, right? You compare the price to the quality and the quantity. You don't get swept up in fancy packaging or some grand hype. You're being a pragmatist. But perfume? That's bought on emotion, image, desire. Graham says an investor has to be the grocer, not the perfume shopper. To put it simply, the margin of safety is your buffer. It's your cushion against the unknown. So if you figure out a business is worth about $1 per share, but you buy its stock from a panicked Mr. Market for just 60 cents, well, you've got a 40-cent margin of safety. This protects you. It's a cushion, not just for your own miscalculations, but for the simple fact that the future is and always will be unpredictable. Okay, so that's the philosophy, but how do you actually put it into practice? Well, Graham provides a really simple, clear playbook for what he calls the defensive investor, which, let's be honest, is most of us. It's a really simple three-step plan. First, you keep a balance, about half in stocks, half in bonds. This acts like a stabilizer. It keeps you from getting too greedy when times are good or too scared when times are bad. Second, you diversify across a good number of large, stable companies. That way, one bad apple can't blow up your whole portfolio. And third, and this is the key to it all, you automate. By investing the same amount of money every single month, you naturally end up buying more shares when prices are low and fewer when they're high. It forces you to be rational.
And that is the beauty of this whole thing. This isn't about being smarter than everyone else or trying to predict the future. It's a system that's designed to protect you from making emotional decisions. It forces you to be disciplined, which, as Graham argues, is the real key to success. It protects you from your own worst enemy, yourself.
This story might just be the ultimate proof of Graham's point. Sir Isaac Newton, that Sir Isaac Newton, one of the most brilliant minds in all of human history, got swept up in a speculative bubble. He invested early, sold, and made a nice profit. But then he couldn't stand watching everyone else get rich. He jumped back in at the absolute top and lost a fortune. It just proves that success in investing isn't about IQ. It's about having the right temperament. And that really leaves us with the central question of the intelligent investor. The real risk isn't in your stocks, it's in how you behave. The greatest danger is the person you see in the mirror. It's the timeless question Graham leaves us with. Thanks so much for joining me for this explainer.